Let me make sure I'm recording first so I don't waste any time. Okay, what's going on, everyone? We're going to talk about Project Ion. You may have heard of it, you may not have. Basically, my hypothesis after reading this has all been planned from the start. Everything, even crypto, even the NFT situation, everything is bullshit. And I'm going to try to explain why, and it's based off of reading what this document's all about. So let's look at Project Ion by the DTCC. So this is written in May 2020, Project Ion case study. At this point in time, they'd already been developing this. You'll see when this starts towards the end. But basically, let's go ahead and take a look. So we'll start with the executive summary. And the executive summary, basically, the U.S. financial industry's clearance and settlement model has evolved to be among the most cost-effective and efficient in the world. Since its creation almost 50 years ago, the mission of the DTC, or DTCC, has been to help the industry mitigate risk and reduce cost in clearing and settlement by driving out operational and capital inefficiencies. Fulfilling that mission has been a key driver behind DTCC's long-standing commitment to advancing fintech initiatives such as automation, robotics, artificial intelligence, and more recently, distributed ledger technology, or DLT, and the digitization of assets. So, again, this was written in 2020, talking about digitization of assets. This paper describes DTCC's latest advancements with digital processing to shorten the time between trade and settlement, and the potential to leverage DLT as a pivotal piece of technology that may help bring about new efficiencies in clearing and settlement. So basically, when did this start? Well, for many years, and this is as far as accelerating and optimizing settlement, the markets operated on a T+5 settlement cycle, trade date plus 5 days to settlement, and that changed in 1995, in which case U.S. regulators reduced the settlement cycle from 5 business days to 3, and then in 2017, after many years of a wide-reaching, extensive technology and operational effort, coordinated and harmonized across global markets and regulatory bodies, another day was removed from the settlement cycle. Today, the industry effectively completed or completes settlements for trades in equities and certain debt securities on the second day after a trade is executed, or T+2. Even after achieving T+2, DTCC continued an aggressive examination of its own core clearing and settlement processes with an eye to further modernizing the capital markets infrastructure across the entire post-trade lifecycle. Although DTCC's current infrastructure supports T+1 and limited T+0 settlement cycles, market behavior, legacy infrastructure, and operational processes at client firms make it difficult to accelerate further without a lengthy industry effort. One can only move as fast as the slowest adopter. Recent market events, and especially the unprecedented volatility experienced in March of 2020, resulting from the COVID-19 pandemic, have reaffirmed DTCC's position that there are still opportunities for industry improvements, which could provide additional operational efficiencies and reduce industry-wide risk and cost. DTCC believes the timing is right to further explore the impact and benefits of accelerated and optimized settlement for the U.S. equities market. To that end, working with our industry clients, DTCC has developed a proof of concept, which they call Project Ion. Now, introducing new and more efficient settlement processes underpinned by advancements in technology provides the best opportunity to modernize the existing capital markets infrastructure and continue DTCC's mission of helping the industry, not helping the industry, mitigate risk and reduce costs in clearing and settlement by driving out operational and capital inefficiencies. So this is basically their proof of concept for this whole idea. So, advancing the industry towards accelerated settlement. As the backbone of the U.S. financial industry, DTCC operates the most cost-effective and efficient settlement system in the world. Centralized netting, clearing, and settlement of nearly every equity trade have contributed to making the U.S. markets the deepest and broadest in the world. Last year, DTCC, through its wholly owned subsidiaries, the Fixed Income Clearing Corporation, National Securities Clearing Corporation, and the DTC, processed securities transactions valued at more than US $1.85 quadrillion. In 2012, DTCC commissioned a groundbreaking industry study assessing the costs and benefits of accelerated settlement for the U.S. capital markets. In 2017, DTCC was proud to partner with industry colleagues to shorten the U.S. settlement cycle from trade date +3 to trade date +2, or T+2, which was a historic achievement that delivered significant benefits to market participants. By removing an entire day from the settlement cycle, the average daily capital requirements for clearing trades was estimated in 2017 to be reduced by 25%. So that's right. So reducing settlement cycle actually reduces the amount of capital requirements they need to have on hand. So again, it just creates more opportunity for manipulation. Now, however, even a T+2, one of the last remaining exposures in the settlement system, is still time. So basically, time increases the risk of an unpredictable event that could significantly affect the transfer of cash or ownership of securities from the point of execution through settlement. That is what they're trying to do. This is what it's all about. Reducing the risk for a MOAS to happen. Whoops. So that's basically their whole ordeal. You've seen it in the filings. That's their main point, is risk mitigation. So T+0 benefits Wall Street for these following reasons. Number one, reduction in risk. The elimination of a market day for a substantial percentage of trades would significantly reduce the risk capital required by NSCC to guarantee trades. The elimination of market day capital requirements reduces NSCC's clearing fund requirements, which create capital inefficiencies for members. Now, it's also going to release trapped liquidity. NSCC would have fewer settlement obligations, potentially reducing the liquidity resources required to guarantee settlement activity, and would also lessen the risk of insolvency. Improvements in the settlement process would produce a significant reduction in U.S. market risk without the elimination of the massive benefits of centralized netting, striking the optimal balance between netting and capital efficiency. So again, I mean, the documents are all there. This is all there for you to go and read. Now, the potential digital accelerated settlement service, this is what it would look like. On the trade capture side, you have integrated to current trade capture capabilities. It's going to allow market and member submission, leverages NSCC's risk practices. On the netting side, you have real-time netting with flexible cutoffs, continuous calculation of net projections, accessible data stream via node or API. On the settlement part, you have atomic T+0 settlement on-chain, end-of-day and intraday slices with partials, alternative settlement, and integrated DTC and NSCC settlement and pre-funding. Pre-funding, how does that sound? And then, of course, the digi of securities and cash, digitalization of securities and cash, and they're leveraging the existing DTC account system, which you all know what that is because you've been yelling about it all year long. DRS, DRS, it's all part of this puzzle. You've been helping them, congratulations. Auto optimization of DTC inventory and Fedwire cash. I mean, Jesus Christ, it's all a lie. Everything we've been told last year. You know why? Because we all got information from the same place, Reddit. This is all Reddit's fault. All of it. No, well, not Reddit. It's Super Stonk and Wall Street Bets. Now, basically, the implementation decisions here to effectively convey proposed business concepts, UI/UX was prioritized over a scalable architecture. Settlement smart contracts were programmed in DAML to evaluate the atomic nature of smart contracts. Cloud-based netting engine was developed off-chain for centralized execution. DTC integration was simulated in the proof of concept for ease of implementation. Simulated data was used in the re-representation of DTC eligible securities and cash. Concepts in scope, mechanism for immobilization. That's DRS. By definition. Concepts in scope, a mechanism for immobilization and re-representation of securities and cash. Redesigned netting engine with real-time projection capabilities. A pre-funding settlement model. Intraday and end-of-day settlement slices. Atomic transfers for bilateral delivery versus payment and free of payment. API integration for trading venues to submit market orders. That's right, they're going to be submitting orders through APIs soon. API integration for clients to consume real-time net projections and manage inventory. only achievable in unison. Mechanism for immobilization. I mean, the evidence is there. It's up to you now whether you'd like to believe it or not. So, let's look at DTCC's exploration of DLT, which is the ledger transactions. This began in 2015. Nope, not recently. It began literally 7 years ago almost. So, in 2015, they deployed the idea, and then in 2016, or between 2015 and 2016, early exploration of emerging tech. That's what took place first. That's what's already happened by the point in time they wrote this article. Then we have contribution to open source. Then we have the evaluation of use cases. Well, what happens next? Operationalizing the tech in 2018. This is a very important time frame. You know why? Because if you look at this time frame, surrounding what's going on in today's markets, talk about a warm-up. That was their warm-up for what they're doing now, which is this shit. I mean, think what you want, but I don't see how it could be anything else. The coincidences are no longer coincidences in my opinion. It all just lines up. Their actions are traceable through, really, their decisions show up in the form of chart patterns, right? Eventually, if you can determine where it comes from, the source of it. Well, all I know is right around this time, guess what? They were trying to pass a filing much like what we saw came out, a month ago, or about actually a couple weeks ago, where it basically pushes out small and medium players, makes the larger players larger. This is why they're trying to get out. And it's taken too long. They're running out of time. But let's continue. We're going to tell the whole story, not just that part of it. So the repo demand skyrockets between 2014 and 2018, likely warm-up period, right? So then what happens? This is the operationalizing the tech period. By 2018, it goes down. Now they're in the operationalizing the tech phase between 2018 and 2019. However, there's another part to 2018. And that part would be prove tech's performance and ability to scale. Well, that's all great and dandy, but something got in the way there. So, 2019, define governance and future business models. Assess regulatory landscape. Doesn't really require much repo action if you're going to be, scaling at that time during 14 to 18. So now they're proving it. They're defining they're basically lobbying for legislation. And then something unpredictable happens, or maybe it was part of the plan, but I don't know. I haven't really determined which side of the fence I'm on there yet. But at this point, for this presentation, we're going to assume it was a delay. COVID delays everything, right? They were ready to go right here. You've clearly seen they were running out of time, and then they had to, all of a sudden, when COVID starts in November of 2019, and we were in the depths of it by March, all of a sudden, they're quickly drawing up plans for SLR. And that's implemented by March 2020, right as the repo demand is starting to go up, and then it disappears right after SLR was being drawn up. Again, not a coincidence in my opinion. And then what happens? Well, since everything was basically delayed a year, right? So if COVID came in 2019, they were supposed to get this done by this amount of time. If that's what their goal was for this Project Ion, was to have it done by 2021. Obviously, COVID could have caused a year-long delay, which is exactly what we saw between March 30th and March 30th, March 30th, 2020 and March 30th, 2021. So starting in 2019, push this schedule back 1 year, and it starts to make a whole lot of sense. 2020, in March, they were supposed to have Project Ion going. Well, they couldn't because COVID delayed them a year in 2020. So 2021, was likely the year they would have had to implement it, given COVID was an actual delay. So then what happens? DTCC's exploration of DLT, 2020. Prove the text security and existing frameworks. Prove text security and existing frameworks. And then what's next? Launch Project Ion, which is the proof of concept, which if you look at what happened, not in 2020, because remember, COVID delayed it. We're going to change that to 2021. Now, what was Project Ion? 2021, if we go back to that chart. We're in Project Ion. Always have been. Not everyone, just Reddit. Stop reading shit on the internet. Read shit on the internet from the source. That's literally the answer to this problem. But anyways, yeah, it's all set up. At this point, I mean, who knows, man? I mean, that's why you just keep looking. Decide for yourself. The information's out there. Don't listen to other people, except if they're reading from documents.